In our book, Own a Home Cheaper Than Rent, we dive into a large portion of what are the tax benefits. There's a lot to go through in this chapter, but Scott's going to highlight the most important pieces right now.
All right. Like Zach said, the book contains a good 20 pages that talks about tax benefits. And in the book, we actually boiled it down to a 2 to 3 page overview that someone could just go in and do a quick rundown of those benefits. And we're going to give you an even lighter overview than that, just to talk about some of our favorite tax benefits. But if it's something you want to dig into, man, it's in the book, and knock yourself out. You'll have a good time reading that kind of stuff if you enjoy that. Tax benefits. One of my favorites is depreciation. Now, when you own a property, what you get to do every year is deduct some of the value of that property and write it off to offset the income that you generate from your rental income. And in many cases, you can just wash it right out and not have any income at all to claim on your taxes. So depreciation is a really cool tool. There are a lot of rules about how many years you get to deduct it and what you can deduct and what you can't deduct. You can't deduct land because you can't destroy it, but you can deduct a house because it's something that wear and tear over time wears it out and uses it up. So depreciation is your friend. Another thing that Zach and I both love, in fact, this is probably my favorite tax strategy of all, is what's called the step up in basis. Because when you buy a property, you buy it at whatever you paid for it, and that's considered your basis. And then over time, of course, you depreciate it, and it goes down a little bit as you do that. But when you sell it, you end up paying tax to the government. It's going to be short-term and probably long-term capital gains in most cases. The difference between what you paid for it and whatever your basis is. And you're going to owe capital gains tax. Well, step up in basis basically says that if you die and your heirs inherit that property, their basis in the property becomes the fair market value of the property on your date of death. And so all of that capital gains gain gets just washed out and it just disappears. Your family could then sell the property for whatever the value was. I mean, let's just say, for example, let's make it really simple. In the book, we do an example, and I don't remember the exact details, but let's just say that you bought a property for $200,000 and then you depreciated it down to 100 over a period of time, and then you sold the thing for $1 million because you wanted to give the money to your kids before you die. Well, you've got like a $900,000 gain there, basically, that's going to be taxed in some form, whether it's recapture or capital gains. You're going to have some serious tax. If instead you don't sell it before you die and you let the kids inherit it, then the value at your date of death, let's say it's $1 million. Now their basis is $1 million. They could sell it next week for $1 million, and there's no gain taxable to them because they inherited it for $1 million. They sold it for $1 million, and there's no tax. It's the most amazing thing. So it's the way to keep the government out of your family, right? And they're not part of the inheritance process if you do it right. So I love this, and this is how families create generational wealth and how they just pass it on one generation after another, and they keep the IRS out of their pockets. Then another tax benefit that we talk about is the primary residence capital gains exclusion. A lot of people don't realize that when you own a home and you sell the home that you've been living in, as long as you've lived in it 2 out of the last 5 years, you can deduct as a married couple up to $500,000 of gain and not have to pay any tax on that. You can exclude it. And if you're a single person, you can exclude up to $250,000 of gain. So this is fantastic, because let's say you bought the house for $500,000, you hold on to it for 10 years, you've lived there at least 2 of the last 5, you sell it for $900,000. Well, there's $400,000 of gain right there that you don't ever have to report or pay any tax on because it was your principal residence. Now, the cool part about this in particular, and why we put this in the book, is there's this really nice loophole that has to do with accessory dwelling units. And the loophole is if your accessory dwelling unit has an interior access to your upstairs where you live, and the basement that you're renting, and you don't have to go outside to get into that ADU, that separate rented section. If you could access it through your unit, then it's all considered one house. And all of the gain that comes as a part of appreciation over time from your ADU gets rolled into your personal, and it gets wiped out through this gains exclusion as the personal residence, because those residences are attached. If they're not, then you actually end up with separating it. You potentially have more capital gains on the piece that's the rented portion, but it's a really nice little loophole that very, very few people even know about. So that's it. Dive into the book and at least read the summary. There's a lot more than what we're talking about here, but these are some really nice little nuggets that you could get excited about, and wet the whistle on tax benefits of owning real estate, and in particular, something with an accessory dwelling unit. If there's something here that piqued your interest, reach out to us. Jump online, go to househackanalysis.com and just put some time on our calendar to talk to one of us, and we can talk in more detail. And then keep an eye out, because every week or so we're going to send out a new video, and the next video that's coming up is what's called a guide for your journey, and we're going to talk about the different ways that people go about buying real estate and what the most successful people do. So keep your eyes out for that in the next week or so.